Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Wednesday, and that means we are lucky enough to talk to the one and only Anna Kelly. Hi, Anna.
Hi, good to be here with you today.
Yes, we've got three important topics today. The first one being the recently published, as in the last hour, 61 minutes ago, this was published, the National Association of Realtors summary report of August existing home sales.
Yeah.
And not to steal any thunder, but they were a disaster. And
Yes.
I think we need to look at their summary report, not only to digest what happened in August, but to kind of look into the future. Because I don't know about you, I thought August would be okay, because rates ticked down about half a point. I have no good feeling about September through March. So I know you looked at it briefly. What are your kind of initial reactions?
Yeah, initial reactions is I'm not surprised. I know you're not either. In that we've been saying, there's going to be a crash in transactions for
Yeah.
sure,
Mhm.
and in certain markets there's definitely going to be a softening. I think I read this morning and I just glanced at that we were down to lowest level of sales since 2014. So it's been a long time.
Yeah, transactions undoubtedly down. The one that I'm going to get the heat for, and frankly deserve, is I thought median home price would tick up, less than 1% from 4038 to 405, and it came in at a whopping 389. So,
Right.
so that's a huge miss. I need to own that miss. I like to celebrate when I get them right, so I don't mind admitting when I'm wrong. And that was a precipitous drop. June to August, historically speaking, is about 2%. It's seasonal. This
Right.
was 6%.
Right.
And that got my attention. So pretty crazy.
Yeah, it's really interesting. I mean, we've caught a lot of things right on this show because we've had a lot of experience. We've been through, the Great Recession, we've been through the pandemic, we've seen kind of these, anomaly events and what
Mhm.
they do. But every area is so different, right? And there's
Mhm.
some areas of the country, I think half of the country actually went up in value,
Yeah.
and half of the country kind of came down in value a little bit. And
Mhm.
so it's very much regional, and that's what we need to continue to slam
Yeah.
home, to drive home to our listeners, is that real estate is hurting. There's probably more pain ahead, which I know we're going to talk about on this show. It's still, up in the air as to how bad is it going to be? How
Mhm.
bad do prices drop? In some areas, they're still so undersupplied that, like you thought before, we might see an uptick in values in some markets, but
Oh yeah.
other areas, are primed. I was reading another report today, put out by Moody's, that looks like quite a few areas of the country are primed for 15 to 20% drops.
Wow. Yeah. It is going to be wild to watch. Kind of, I think any area where iBuyers were dominant, Phoenix, Vegas being clear examples, big trouble.
Right.
Any of the Zoom towns like Boise was the first market I called 6 months ago, big trouble.
Yes.
Again, I'm not seeing a negative number in the median home price for the year. I will clearly own and admit my 405 was wildly off. Came in at 389. But let me bring up the report so everybody can see it. You and I can
Right.
react to it, and we'll talk about maybe what we see coming.
Perfect.
Hopefully, you can see that now. Can you?
I can.
Awesome. Let's move our picture over here. So again, this is their summary deck. I will read their detailed one, but I haven't had time. But here is the annual pace, 4.8, clearly down. This one I got semi right, but it's not really worth taking credit for. Expectations were 4.7. I thought we would go to 4.85. So I was closer, but given how far off I was on price, I'm not taking a victory lap here. This was kind of easy because, again, we saw that rates tick down. So there were a lot of buyers that kind of rushed in. And I will say this much: we are about to see significant legs down in this number the next 6 months. I think we go under 4 million sometime in the next 6 months. What do you think?
Yeah, I agree with you. There's a lot of, obviously, homeowners are not incentivized to move right now and pay
Exactly.
substantially higher rates. Where rates were at the beginning of this year, what could buy you a $500,000 home for the same payment today is a $350,000 home. So
Yeah.
you can bet if someone's in a $500,000 home, they're not trading down for one that's worth 350, right? So you're going to have a lot less sellers sell unless they're really motivated and need to sell,
Mhm.
and that alone will hurt one side. then you've got continuing rising rates, which we will see today.
Yeah.
And that is going to continue to make housing less affordable, as we've already reached 6% 30-year fixed primary home mortgages. So I would agree with you.
I saw yesterday it's 6.32 is the national average. And so that's a cycle high. The peak in June was 603.
Yeah.
So now it's 6.32 and going higher. It wouldn't shock me if we saw a 7 sometime this year. How does that feel?
It's definitely crazy. You know, I got my home just exactly 2 years ago at 2.6%.
You're never selling, never refining.
Absolutely. There's no reason to, you know, so it's a substantial difference. And what people don't recognize, you know, I see a lot of Facebook posts that'll say, wow, my first mortgage was at 10 or 9 or 11, and this is no big deal. But what people fail to appreciate is the velocity and the speed of the change, and what a shock it is to everybody's system when it happens so quickly. And so it really does a number on our psyche as to, wow, I've been looking at houses, I could have bought this, and now I can only buy this. And it feels we feel much poorer, and there's less motivation to buy something because everybody's bracing and hoping that, you know, in a couple of years, things will correct and then they can, you know, afford a home again. So the velocity and the speed at which the rate has changed is really why you see such a drastic drop in, you know, housing demand.
Yeah, this transaction is going to get much worse. Again, I think we take out the 4 million number before this is over. I'm now calling phase 2 of the housing crash, which again is mainly transactions. Started September 15th, so about a week ago, and will run to March 15th. I have no idea where the economy will be, unemployment rates in March. I will make an opinion in March. No, let's be clear. I'll make an opinion in February about March, but yeah, this is not good. Now let's get to price, which lots of people are going to like to point at and make fun of me, which I'll own. That's okay. I don't mind being wrong. I like taking victory laps when I'm right, so I might as well take it when I'm wrong.
That's right.
It came in at 389.5. I thought 405. What's not listed here is last month was 403.5 or 403.8. So a 14,000, let's call it 14,000 drop in a month is not unheard of, but on the outer bounds of ouch, that got my attention.
Absolutely. And it's not surprising, Michael. I mean, if you go back to, you know, the middle of 2020, in 2 years, certain markets, especially in the Sun Belt in Florida and Arizona and Nevada, have gone up over 50% in 2 years. So even if you drop 10%, you're still 40% above, you know, where housing was in 2020 before the pandemic. And so I think there's a way to fall in those markets that went up in an unreasonable amount compared to the underlying fundamentals of those economies and what affordability is based on the wages there. So if we tick into a recession on top of inflation being, you know, killed and interest rates going up, you're going to start seeing affordability get even worse. And that is going to cause some softening in home prices for sure.
Yeah. The last thing to point about here, you brought it up actually before the slides. I just want to hit this again. This is median home price for the country.
Yes.
It should mean almost nothing. I'll take that back. It should mean nothing to everybody watching this. This is something I've been geeking out about for 20 plus years. It is something that I look at as an economist because this is something I studied in school and I've never stopped looking. But again, your buy box, your area, daily discipline, write great offers, get closing cost credit, get rate buy downs, don't pay list price, go get great deals. But again, I'll own this. I was wrong about this number. Next, kind of where are we at? These are year-on-year numbers. These are the things that I follow. I still don't think we see a negative year-on-year this year, right? Which is what I've called all year. Although I got to tell you, this drop from 15 to 7.7 was pretty quick.
Yeah, it definitely was. I don't think we dropped negative nationally year to year as well. I do think in 2023, as the Fed probably sustains its higher rates for a year or so to let inflation come down, I expect this number in 2023 to be pretty close to flat nationally. And in many markets, it's going to be negative.
Yeah, I haven't changed my opinion. I know this chart, you know, if you just kind of extrapolate this chart, I should change my opinion, but I'm not. I think housing is roughly flat, by flat plus or minus 2% for the next 5 years. I think it's rather boring.
Yeah.
But again, when you look at this chart, if you're not in the data, you could look at this and say, Zuber, you're crazy. Why won't you change your mind? It's because I still don't believe it. Again,
Right.
I admit when I'm wrong, but being wrong once doesn't mean that, I have to change my opinion.
Right. And one of the reasons for that is because many people have been saying housing's going to crash, values are going to crash, are going to scoop up prices just like they were in 2008. While that is possible, again, in certain markets that were extremely overvalued, we have to realize that there's going to be a continued lack of supply because people do not want to move when things are more painful. And so the lack of supply will keep prices up when otherwise, if there was still a lot of supply, and then you had this decline in demand, you'd see significant drop in values. But the supply constrictions are going to continue for some time, and that's going to keep us, I think, from experiencing a massive housing crisis and crash in value.
You've kind of highlighted exactly phase one, phase two, and probably what will be phase three. Phase one for me, the housing crash was the first 30%, which I called and got right. Was demand destruction, right? Black Knight wrote a report months ago that, hey, when you go from 3 to 6, this was in June, we lose 14 to 16 million William buyers because they go from getting a yes answer to a no answer.
Yes.
That's a problem, right? So that was phase one for me. Now that rates are going, I'm thinking we're back to 6.3. I think they're going to 7. We are going to see, for the first time in 40 years, this is what most people don't understand, and you just brought it up. Phase two of the housing crash for me is supply destruction.
Yes.
That is why I have very horrible feeling about the next 6 months. We're going to go sub 4 million annual transactions for quite a while and might be just record dropping. It is demand destruction phase one plus now phase two, supply destruction. That gets us to March. And in March, I have no idea what's going on. Unemployment, interest rates, the war in Ukraine. I mean, I have no idea. I am not making any predictions past March because for the first time in my adult life, the next 6 months has so many off ramps. I have no idea which way we're going.
I would say the second time for me. The first time was the pandemic, right? The biggest unknowns that I ever experienced as a real estate investor. But yes, there's so many things that will impact the U.S. economy that are outside of the Fed's control. So one, what happens when the Fed raises rates? How painful does it get? How long and deep and diffuse is a recession? But what happens with Ukraine and Russia, with China going after Taiwan potentially? There's a lot of different things that can really cause some pain. So, like you, I'm not betting on what's going to happen, but we can look at these trends day after day and see where are things headed and how do I need to react with what I'm buying today. Do a good deal for today based on what you know and what the things that we talk about, likely outcomes over the next year. And as long as you're a long-term buy and hold investor, which we are, we will weather ups and downs that last a year or two or even more, as long as you buy right. And so, this isn't to scare you and say, don't buy, or to say you're going to get the best deals in your lifetime. You may or may not, but watch the statistics and watch your local markets and keep doing good deals.
So again, this is the housing transactions. This is the one I kind of got right. I thought we would be down 20%. We were down 19.9. We were a little better than last month. That's what I said. But again, I got to tell you, this is the last semi-good transaction number. We saw a little blip in interest rates in late June and July, which caused some people to rush in and buy. This chart is going to get ugly, ugly, ugly. We have horrible compares. Interest rates a year ago were sub 3.5. All of these compares, and we might be at rates at 6.5 or 7 going forward. These percent transaction crashes are going to be ugly.
Absolutely. And again, this is the average. There are markets that are already down 40% in transactions in the United States.
Yep. So here it's kind of just these are interesting numbers. First-time home buyers. Again, these are percentages. These are percentage of sales. So again, transactions go down. So you may see less total first-time home buyers, but this is a percentage of the transactions. So again, first-time home buyers, roughly 30%. Sales to investors. This one's interesting. It actually went up to 16%. Cash buyers up. Again, I suspect cash buyers are down, but because, again, less transactions, the percentage looks better. Distressed sales still not there. And this is one I was hoping for. Days on market was at record low for 3 months, I believe, 14. It ticked up to 16. This has to go higher. This, by the end of the year, could be over 30, in my opinion.
Oh, absolutely. Absolutely. And I think that one of the things I'm going to go against the Realtor Confidence Survey.
Yeah.
I do believe that investors, you're going to have many investors that start dropping out. Why? We talked about this a little bit before in a previous interview, but essentially when things start to go crazy in the economy, banks starting to tighten, their credit criteria, their loan to value that they'll offer, the rates. And so as homeowner rates might go to 7, investor rates may easily go to 10. So you're going to have a lot of investors that freak out. They can't buy, they can't get hard money, private money, cash. Yeah. And so I think your cash sales, your investor sales actually drop, which gives us a leg up if we're still in the game and can continue to close deals.
Yeah. And again, the other thing that I think is going to be very important as the Fed raises rates and the 2-year and 1-year go higher and higher, the risk adjusted return, there are more. I mean, I have to tell you, for the first time in my adult life, I looked at buying the 1-year treasury. I've never even considered that. First, I never had a lot of money because I was always buying stuff. Right. But I actually looked at 4%, right? I'm getting, sub 1 in a bank or whatever I'm getting now. Maybe it's 1%. I have no idea. I haven't looked.
Yeah.
But
yeah,
I actually looked at it I looked at buying treasuries. I don't know what's wrong with me.
Just a tip. So I did too. I bought $10,000 of I bonds for every member of my family.
Nice.
For those of you that don't know, maybe we could do another show on this, but you can get an inflation adjusted bond, only 10 grand a year. But right now it's paying 9.63%. So it keeps up with inflation. It's a savings account.
Where did you buy that?
On UStreasury.gov, directly from the US Treasury. So again, you're not going to make a lot of money, but you're going to keep up with inflation. So at least you're fighting inflation rather than having your money sitting in a checking account making 1 if you're lucky.
I am going to buy 10 grand of I bonds today. Anna Kelly's doing it. I got to do it.
It's much better than a flat 3.5 that you're still losing 5 to inflation.
There you go. All right. Got a couple more slides to get through to wrap this up. Again, home sales. I wish they would do like a yearly compare of this because this really means nothing to me. My memory doesn't go back that far to like, is 18% good or bad? This is just how the transaction split. The South clearly cranking.
Yes.
I have to imagine that we don't normally see 45% of transactions in the South.
As companies continue to move out of liberal cities and states and move to Texas and North Carolina and Florida, this is just going to continue, in my opinion.
I think South in their definition is Texas East, I believe.
Hey, everything is Texas, right?
Yeah, exactly. This is the sale price, which I thought was interesting. The next chart is very interesting. This, again, is a split where the transactions are. And again, let's remember the median price was roughly $390. So you can see lots of the transactions there. This is the chart we should go to. This one was interesting because, again, I was thinking about median home price, right? It's just the middle.
Yes.
I expected the low end of the market to fall a lot, which it did. Look at this, right? 21, 26. It's where the most fell because, again, nobody has first-time homes. The move-up buyer's gone, all of that. I assumed, this is really weird for me because I got this right, but still the math didn't work out. This is what I expected. The biggest fall was in the low end of the market, which would mean, again, logically speaking, if the high end didn't fall as much, it should pull the median higher, hence my 405 call. I got what I expected in the numbers, but it didn't work out. I'm like, what the hell?
Right. Because there's not as many homes that are selling in the $1 million+ price range, right?
Yeah,
so if you look at the numbers of people that are actually buying those homes, it's going to skew the average down a little more than you would expect, I think.
Well, that's exactly what happened. Because if you just add these three colors,
right,
which are the only one, these 3 buckets are all above the median. What is this? 18, so 25. So 31% of transactions are clearly above the median.
Right.
So I got it right, but I got it right, but got it wrong, right? My logic was sound.
Right.
But
and here's the thing. I think these numbers, I think in your high end, yes, you've removed the move up buyer that was really keeping transactions high at the $500,000+. But at the same time, the people that are making $500,000+, enough to buy a home that's $500,000+, are really not hurt nearly as badly by the interest rate increases. They'll buy what they want anyway.
Mhm.
But the people that are there from 100,000 to 500, I expect those numbers to get substantially worse. And really anything below 500,000, I expect that there's a much larger change over the next several months as rates go up.
Yeah, again, these numbers aren't going to get any better. These numbers on the left, and just in case you can't see where my cursor is, 22 down 26. So again, we get rates up to 7. These go much lower because again, it's all about getting a yes answer from a bank. But then let's not forget what I expect to happen sometime next year after the midterms is first-time homebuyer programs go on steroids, and that could push this up. So.
And they have already started. There's new minority loan programs, just like we talked about last year, that would start being rolled out that are back at 0% down, rolling your closing costs, and the government's going to try to do that to help with affordability, somewhat.
Yeah. Very cool, Anna. Well, do me a favor. Where can people find you?
Right. You can find me here every week on my playlist on your channel. You can find me at social media, Anna Kelly, REI Mom. And you can find me at my website, reimom.com, if you're interested in coaching or mastermind.
Thank you so much.
Thank you.